Imagine you are a global investor with billions of dollars to invest. Would you rather lend your money to the Indian government or the United States government? Now here's the shocker. Until recently, investors were getting a massive bonus for choosing India. But now, that extra reward is disappearing fast. The gap between India's 10-year government bond and the US 10-year Treasury note has narrowed to just about 1.88 percentage points. Back in 2014, this difference was as high as 6.35 percentage points. That's a huge drop. But before we dive into this eye-opening trend, make sure to hit that subscribe button so you never miss insights that could shape your financial future. So, what exactly is this yield gap and why does it matter so much? Think of bond yields like interest rates the government pays to borrow money. If India offers a higher yield than the US, it's like saying, "Hey investors, come here. We'll give you more return for your risk." For years, India was doing just that. But now, the return gap is shrinking. And when that happens, big foreign investors start looking elsewhere. Places where they can get better returns for the same amount of risk. Now, let's talk about what's causing this change. India's bond yields are falling. That's because inflation is under control. The Reserve Bank of India recently cut the repo rate by 50 basis points, bringing it to 5.5%. This signals a soft monetary policy, which usually lowers bond yields. Add to that India's improving economic fundamentals, strong foreign exchange reserves of around $700 billion, and a reduction in government borrowings. And you have a perfect recipe for declining yields. Meanwhile, in the United States, things are moving the other way. The 10-year Treasury yield rose to about 4.42% due to fiscal worries, rising debt levels, and overall policy uncertainty. Now here's the twist. With Indian yields going down and US yields going up, the yield gap is getting smaller. That makes Indian bonds less attractive to foreign institutional investors because they are not getting paid enough extra to take the added risk. One bond market expert pointed out that unless the yield gap widens again, we might see lower foreign inflows or even some outflows. But don't worry just yet. India's economy is still strong. Forex reserves are solid. And inflation is well within the central bank's comfort zone. Another fixed income expert says this narrowing yield gap is actually a reflection of India's fiscal discipline and stable debt levels. The country's fiscal deficit is being brought down with a goal of 4.4% for the year 2026. Debt to GDP is around 82%, far more manageable than the US, where it's roughly 120%. And get this, the US needs to refinance about $9 trillion in debt by 2025. India, on the other hand, is reducing its borrowings. So even though the yield spread is narrowing, India is still seen as a strong investment destination, especially in the long term. So what should Indian bond investors do right now? Experts suggest looking at shorter-term corporate bonds in the 1 to 2 year range. That's because the yield curve is steep, meaning short-term interest rates are low but long-term rates remain high. If you lock in money in long-term bonds at today's rates and rates rise later, the value of your bond will fall. This could mean long-duration bonds may underperform in the near term. And here's something many people overlook. Compared to countries like China, Vietnam, or Thailand, where benchmark yields are around 2 to 3%, India's 6.5% yields are still quite attractive, especially when backed by economic growth and policy stability. In short, yes, the narrowing yield gap could slow down foreign inflows. But India's long-term story remains strong. The fundamentals are improving. The policies are stable. And for smart investors, India continues to offer steady and promising returns. If you found this breakdown useful, make sure to like the video, share it with someone who tracks bonds and markets, and tell us your thoughts in the comments. And of course, subscribe to Demystify Finance for more financial stories that actually make sense. Until next time, stay aware, stay sharp.